Hey guys, this is Futures Analytica here. Today I'm going to be showing you guys the first episode of our order flow handbook. I'll essentially be showing you guys the basic structure of how to trade the Analytica Chart 3 and what each term means when I use them in my videos. So in order to understand order flow, you first need to see how the chart is structured. So first of all, on the left we have sellers and on the right we have buyers. The only buyers and sellers that are represented on this chart are active market buyers and sellers. These are people who are crossing the spread aggressively in order to prioritize the speed at which they are filled versus the price at which they are filled. In essence, these are aggressive buyers and sellers. And if you know anything about depth of market and market structure, what moves the market is aggression. People who are trying to get in fast. That is what moves the price. Passive buyers and sellers do not affect the price in an active way. They only affect how the market reacts to active buyers and sellers. In essence, active buyers are playing offense and passive buyers are playing defense. The bottom bars of the chart represent the bar's net delta, with the total number of active buyers and sellers being tallied up and a sum is calculated. Positive numbers mean there are more active buyers in that bar, and negative numbers mean there are more active sellers. When there is a difference in the direction the price is moving versus the polarity of the bar's delta, this is called a delta divergence. Like all indicators, delta divergences require more context and cannot be traded alone. But delta divergences can often be used to indicate that a range may be about to break out, and I will explain why when we get into absorption. In order to trade order flow, we need to abandon the traditional way we think about markets. Stop thinking about price moving up or down, but think of it like a game of tug-of-war. In tug-of-war, aggression from both sides at the same time will result in very little movement. We can relate this to range-bound movements in the markets. If there is one side of the rope playing passively and simply defending by not exerting energy, but simply resisting force, that side is depleting the other side's energy resources, which would be absorption depleting a market order from the opposing side. This can open up a counterattack, so to speak, where there is a sudden and quick price movement opposed to the absorbed direction. These movements are what order flow best capitalizes on. Resistive absorption is where price is stopped from moving upward. This can be spotted by a pattern of zero active sellers repeatedly holding a price level, where inversely, supportive absorption can be spotted likewise in the bottom right-hand corner. We can remember this by remembering that active sellers are on the left-hand side and active buyers are on the right. If there is no active buyers or sellers at a price point, but price is not breaking past it, we can assume that passive market participants are holding price at that level. You might be thinking this is just support and resistance, but the difference is that we can spot actual support and resistance as they are happening rather than in hindsight. We also have access to imbalances to add another confirmation that we have a breakout. An imbalance is simply an abnormally high ratio of active market participants on one side compared to the other. This is best used as final confirmation on your trade thesis to enter or exit a trade. Once again, never trade imbalances without considering the other factors of order flow. In this image, we can see bullish imbalances above our entry point. Using conjunction with the other techniques stated before, we can finally buy into this trade. Although there were multiple imbalances, I will assume that you were paying attention to the market this time, and you spotted the first bullish imbalance above the resistive absorption. We will mark this as our entry point. After we enter, we will place our stop loss one tick below the nearest repeating supportive absorption level that we can find, and we would use resistive absorption if we were going short. This distinction between the two types of absorption is very important, as many times I have won trades that were one tick away from hitting my stop simply because I placed my stop one tick away from absorption. For beginner traders, I suggest using a 1-to-1 risk-reward ratio for placing your take profit, and to base this off of where you place your stop loss. But if you're intermediate or advanced, I would suggest trading at least one runner to capitalize on huge price movements like this one. We can see that if you stayed in this trade until you saw a contradictory signal, which was this imbalance, you would have captured over 150 ticks on ES, which is equivalent to around $1,800 on one mini contract. I would like to point out that price movements like these are not very often. They usually only happen once a day. My average trade size is 50 ticks, but my median trade size is 25 ticks. This essentially means that although there are often large trades which skew my average trade size upward, most of the trades that I take are often around the 20 to 30 range. One more thing to consider is that not all zeros are absorption, and not all absorption requires zeros. This is an example of a breakthrough imbalance. This is a fairly common occurrence which indicates a very quick price movement is about to happen, where all of the passive participants at that level were blown away, and that defending that price level has now become too expensive. It is recommended to have a fairly tight stop when trading breakthroughs, because if it is going to fake you out, it will likely do it very quickly and leave you with very little time to react. However, when using this with the other techniques taught in this video, breakthrough imbalances can give you a fairly common, high probability trade. There are many ways to use the tools that the Analytica Chart 3 provides to capture alpha in many different market regimes. Here are 2 other relatively simple ways we can capture risk-averse alpha. These images are posted on the Futures Analytica website if you would like to investigate these strategies further. If you're interested in trading this chart, check out our website in the description. We offer the most affordable order flow chart in the industry by a long shot, as well as it being one of the most feature-rich add-ons for your money. I'm required to disclose that this video is for educational purposes only and should not be construed as investment advice or a recommendation to trade futures or any other equities. If you want to see more of this content, please let me know, and I'll see you guys in the next one.